Okay. Okay, so good evening, everyone. So we are dealing with chapter 14. This is our last chapter. We are learning cost of capital. So the first question is, there's a company has a capital structure which is based on 30% debt, 5% preferred share, and 65% of common stocks, right? So capital structure means where are these? How did you pay for capital, right? To run a corporation, you need to have assets, right? So who paid for it, right? So either can paid by the creditors. You borrow money from the creditors; those are the debt, or you take the money out of your own pocket. So those will be the equity, right? So you have here 30% debt, 5% preferred stock, and 65% common stock. Okay. And when you add up the percentage, 30%, 5%, 65%, this adds up to 100%, right? So it has to be, this percentage has to add up to be 100%. Okay. And the after-tax cost of debt is 6%. Okay, so it's really important here. It says after-tax cost of debt, 6%. So now we learned the cost of preferred share, 7.5%. The cost of common stocks, 11%. Okay. So the company is considering a project that is equally as risky as the overall firm. This project has initial cost of 150,000 and cash inflows of 76,000 a year for 3 years. What is the projected net present value of this project? Okay, so if you know initial cost, so that's 150,000. You know there is an annuity, the cash inflows 76,000 for 3 years. So this is annuity, right? And they're asking you projected net present value of this project. So whatever are we missing? So let's say you know the initial cost and you know the cash flows and for how many years. Now you want to calculate net present value. So which information you are missing now in order to get that present value? Can anyone tell me which information you are missing? Anyone? To do that present value calculation, you have learned this in the previous chapters, right? You know the initial cost, you know the cash flow, the payment, and the 3 years, and they are calculating the present value. So which information you are missing here? If you don't know, just guess. Yeah, rate. Thank you, Godfrey. Yeah, rate of return. Yeah, the yield, right? The yield. So what is the expected return of the project, right? What is the yield? Well, that has to be related to the risk, right? So here, the company is considered a project is equally as risky as the overall firm, right? The return goes along with the risk, right? If the risk level is the same, so the expected return of the project should be the same as the expected return of the firm, right? So now the question becomes, how are you going to calculate the expected return of the firm, right? And that will be the cost of capital, right? The expected return of the firm would be considering expected return of the debt, expected return of the equity, right? And you put the weight. So you calculate the cost of capital. So once you figured out what's the cost of capital of the firm, so that same rate applies to this project because it's equally risky. Okay. So now let's take a look how to calculate the cost of capital. So the capital include debt, preferred stocks, common stocks, right? So the weight for each one, right? Each one has a weight. So we learned that information. So let's take a look. The calculation. For the debt, the weight is 30%, and the after-tax cost of debt is 6%. So I times 6%. So I didn't times 1 minus t, right? If you remember in the textbook, the equation include 1 minus t. In that equation, the cost of debt is the pre-tax cost of debt, right? So you apply that tax shield on the pre-tax debt cost of debt. In this question, this is the after-tax debt cost of debt. So therefore, there's no need to apply that 1 minus t. And 5% for the preferred stock, and that cost preferred is 7.5, and 65% of common stocks, and the cost of stock, common stock is 11%. So when I do this calculation, I get my cost of capital to be 9.325%. Okay, so this is the cost of capital of the firm. Okay, and the project has the same expected return, 9.325. So therefore, I'm going to calculate the ordinary annuity of the cash inflows, $76,000 for 3 years, right? So I'm applying that formula. So R is the expected return, which is 9.325%. N equals 3, and the payment equals 76,000. So I calculated the ordinary annuity to be $191,269.53. So this is the present value of the ordinary annuity, and I need to consider the initial cost. So I take the difference. So when I take the difference, I get the net present value. Okay, the net present value of the project is 41,269.53. Does this make sense? If this makes sense, please give me a hand up. Sorry, give me a thumb up. Thank you. Yeah, good. So I assume that you guys are all comfortable with this question. I can move on. Okay. So the second question here is about, oops. A firm has a target debt to equity ratio. So debt to equity ratio, 37%. So the cost of debt is 9%. So here, when they say cost of debt is 9%, we assume that this is the pre-tax, right? This is the pre-tax cost of debt, 9%. The cost of equity is 15%. Okay, can anyone tell me why the cost of equity is higher than the cost of debt? So in general, the cost of equity will be higher than the cost of debt. Can anyone tell me why? Why cost of equity is normally higher than the cost of debt? why the equity holders expected a higher return than the debt holders? But now you should know the answer, right? I make it pretty clear. Why would the equity holders expect a higher return than the debt holders? Yeah, so investment, yeah, it's investment, right? Both people, when they issue the debt or people issue the stocks, this is all investment. Yeah, either a debt investment or a stock investment, right? So why the stock investors expecting a higher return than the debt investors? You should know this if you have learned chapter 13, right? We need to know how to do the calculation, but we also need to understand, why certain characteristics, right? Certain trend is there. So you almost see in the questions, the cost of equity is always higher than the cost of debt, and why, right? It's a fair question. So what is the return associated with? That is tax deductible. That's true, yeah, but that's not the reason. So what is return associated with? Chapter 13. Mm-hmm. Hayden, that's correct. Risk, right? So why do you think equity holders expecting a higher return than the debt holders? Hayden, because equity holders is taking more risk. Yeah. So equity holders is taking more risk, right? Because if a company is dissolved, so the debt holders will have the claim first, right? They can take the resources, the money first. Whatever left is for the equity holders, right? So if you want to be a boss, right, you are taking a lot of risk to run a business. It's much easier just to lend money to other people, right? Because you're gonna have a lower return, but you are taking less risk, right? So that's the reason. Yeah, yes, exactly, Cheryl. The equity is more riskier, right? It's riskier. Yeah. Okay, so we should know this, right? We should not just know how to do the calculation, but understand all these things behind. The company has a 34% tax rate. A project has an initial cost of 70,000 and the annual after-tax cash flow 21,000 for 6 years. What is the project's net present value? Okay, so in this case, because the cost of debt is 9%, so we assume that that will be a pre-tax cost of debt. In that equation, we have to include the tax shield 1 minus t, right? Because the interest is tax deductible, right? So now let's take a look calculation. So now we are trying to figure out first the weight, okay? What is the weight of debt, right? So when you think about the weight of debt, so you are saying what is the debt versus total asset, right? So that's the weight of the debt, right? There are total amount of debt, asset, how many of that is financed through debt? So debt over asset, okay? And then the asset equals liability debt. Liability is debt plus equity, right? Plus equity. Sorry, plus equity, right? Okay, so knowing this. So now we learned from the question, debt to equity ratio. So debt to equity ratio is expressed mathematically. So debt divided by equity, right? That's the ratio. So that equals 0.37. Okay. So what about asset to equity ratio? Asset to equity ratio. So I know asset equals debt plus equity divided by equity. And this one equals 0.37. We have learned in this equation. And the second part, equity over equity, that's 1, right? So plus 1. So asset to equity ratio equals 1.37. Okay? But we are looking for the weight. If you take a look, the weight is debt divided by debt plus equity. The asset to the equity ratio is that the equity divided by debt plus equity, right? So we have to kind of flip this equation. So here, so the weight of equity. So when I flip this, right? When I flipped the asset to equity equation ratio, asset to equity ratio, when I flip it, so that would be the weight of the equity, right? So equity divided by debt plus equity. So that is 1 divided by 1.37 equals 73%. And now the weight of debt will be the remainder, which is 27%. Okay? Does this make sense? So give me a thumb up if you understand how I was calculating the weight. Okay, very good. I see all thumbs up. Okay. So now you know these numbers. The rest information is given. So then when we do the cost of capital, the calculation is pretty easier, right? For debt, the weight is 0.27, 20%, 27%, times the cost of debt pre-tax, so it's 9%, times tax shield, 1 minus tax rate, 34%, plus weight of equity is 73%, times cost of equity is 15%. 15%. So I get my cost of capital is 12.55%. So now with this information, then it's very easy for us to calculate the net present value. So again, the present value of the ordinary annuity, we are using the formula. We figured out that the 6 years future cash flows in the equal amount of $21,000 is actually worth $85,011 in today's value. And the cost is $70,000. The difference is actually the net present value, $15,011. So that means we're going to have a positive net present value, and this project should be accepted. Okay, does this make sense? If this makes sense, please give me a sum up. Okay, good. So then I guess I'm going to move to the next question. Okay, so Hartley Incorporation needs to purchase equipment for its 2,000 drives in nationwide. the total cost of the equipment is $2 million. It is estimated that the after-tax cash inflows from the project will be $210,000 annually in perpetuity. Right, this is in perpetuity. Harley has a market value debt to assets ratio of 40%. The firm's cost of equity is 13%. Its pre-tax cost of debt is 8%. The flotation cost of debt and equity are 2% and 8%. The tax rate is 34%. Assume the project is of similar risk to the firm's existing operations. So after considering flotation costs, what is the net present value of the proposed project? Okay. Let's take a look. We are going to use the same formula for the cost of capital. In this case, the debt to asset ratio, so that's the weight of the debt, is 40%. So the remaining 60% is for the equity. The cost, the pre-tax cost of debt is 8%. So that has to be, we have to apply a tax shield here, 1 minus 34%. And the cost of equity is 13%. So that's the 13%. So I calculated the cost of capital is actually 9.912%. Okay. And so now you calculate this perpetuity, okay, not perpetuity. So the amount is $210,000, okay, and it goes forever. So the formula would be the equal payment divided by expected return R. So the expected return is 9.912%. Why? Because the project is of similar risk to the firm's existing operation. So the firm's existing operations expected return cost capital is 9.912% because the risk is similar. So therefore, for that specific project, the expected return is also the same as 9.912%. So then I calculated that the perpetuity equals $2 million, $118,644. Cost of flotation, right? When you raise money, if you raise debt or you raise equity, there's going to be cost, right, associated with raising these capitals. So in this case, we learned that the flotation cost of debt and equity are 8%, 2%, 8%, respectively. Okay. So for cost, it costs you 2% to raise debt, costs you 8% to raise stocks, to raise equity, right? Stocks investors. But you have to apply the weight, 40% for the debt, 60% for the equity. So you figured out the cost of flotation is 5.6%. Okay. So to raise $2 million, okay, the initial cost is not $2 million because it costs you money to raise the equity and the debt, right? So to issue debt, right? To issue debt and issue stocks. So the formula is you use your cost you want to raise, right? This is how much you want to raise for the company, 2 million, divided by 1 minus the cost of flotation. So that gives you the actual initial cost, right? The actual initial cost is 2,118,644. So what's your net present value? So you use this the present value of the perpetuity minus the initial cost, including flotation. So that present value equals 0. Therefore, this one can be accepted, right? Can be accepted. Does this make sense? Any question? Flotation cost is actually in the on the textbook starting from page 543. So what happened is if a company issued debt, right? They issued, let's say, bonds, right, to the market, to the debt market, right? So it costs money. It's not like free, right? You're gonna print, right, these coupons, whatever. You're gonna use the brokers, right? So and you probably has to get approved of raise the capital, right, by the security, let's say, commission kind of committee, right? So when you are taking the action to raise money by issuing debts, right? Well, that process costs money. So the flotation cost really saying, like 2%. It costs you 2% actually to raise the cost. Okay. And the same idea when you issue stocks, right? There is a cost associated with that action. Does that make sense? Okay. Yeah, so this is the cost incurred when you are raising capitals. Okay. Your goal is to raise the project, let's say the project initial cost is $2 million, right? Yeah, the total cost of the equipment is 2 million, right? But you get $2 million from the investors, right? So that $2 million is spent on the equipment, but you have additional cost. Is the cost that you are raising the money, the 2 millions from the investors, right? So 2 million is only you paid to the equipment manufacturer. So the other flotation cost you paid elsewhere, right? Because you have to raise the capital. Okay. So if you understand everything, give me a thumb up. Okay, very good. Okay, so now I want you to do this by yourself. Okay, now I give you 10 minutes to work on this question by yourself. Okay, so please actually do it. Okay, and then you have listened to me. I explained it to you 3 questions, right? And this one is similar. I want you to do it independently so that you really understand. Okay, so I will give you 10 minutes to do this question. So please work on it. Okay, so the 10 minutes is up. We're at 45 now. So for the for the sake of the time, I needed to move on. Godfrey got the result, and that result is correct. Hidden and Cheryl, you guys can take your time. But here, let me take a look. So this company considering a project has an initial cash outlay, initial 621, project cash inflows 315, 225, and 212 year 3. The capital structure 35% debt, 65% of common stocks. The company's cost of equity is 14%. After tax, this is really important. After tax, cost of debt for the firm is 5%. So again, you can see 14% more than 5%. The project is a little riskier than its current operation. Thus, management has decided to add an additional 1% to their company's overall cost capital when evaluating this project. What is the projected net present value of the new project, right? So again, to know the present value, because you have all this cash flow information, initial outlay, and the cash inflows for the 3 years. So you just need to know what is the return for the project. What is the expected return for the project? Well, the project is more riskier. The project is a little riskier than the company, right? Other corporate operations. So the management has decided to add additional 1% to the company's overall cost capital, right? So the expected return of the project is just the company's cost of capital and plus 1%, right? So this 1% is to compensate for the additional risk, right, of the project compared to the other operations. Okay, so now again, you need to figure out what's your cost capital, right? And this part, it should be pretty straightforward. So the cost of capital equals the weight of debt, 35%, times cost of debt after tax, right? This is after tax. So in this case, if I use 5%, I do not use the tax shield. Plus 65%, so that's the weight for the equity, times the cost of equity is 14%, right? 14%. Okay, so let me quickly do a calculation here. What do I get? So that'll be 0.35 times 5, 1.75, and 0.65 times 14, 9.1. So I have 10.85. So I get actually 10.85%. Okay. So I know the cost of capital, but because of this project is riskier, and the management has decided to compensate by adding one actual point. So here that will be 10.85%, which is the cost of capital, plus 1%. That's additional. So that's 11.85%, right? So now the question is pretty easy, right? You just use the financial calculator. So your CF0 should be this negative 621,000, right? Your CF1 should be 315,000. F01 equals 1. So CF2 equals 225,000, and FO2 should be 1. And your CF3 should be 212,000 F03 should be 1. And so then you press the NPV, then you press NPV, and then you enter the I. So that will be 11.85, right? And then you go compute NPV, right? Okay, let's take a look. Okay, so you do the CF0, so that will be negative 621,000, negative, enter, and next is 315,000, enter. This one is F01 is 1, enter. 225,000, enter. F021, 3, so that will be 212,000, enter. F031. Okay, now I price NPV. What's my I? I is 11.85, enter. Okay, so now let's find NPV. Let's go compute NPV. Okay. So then the result is 8,000, $8,017.46. Is that correct? Did you guys get this result? Yeah. Okay, Kaden, Godfrey. How about you, Cheryl? Did you get the result? Okay, yours is different. So what is your result? $1.2 million. Okay, so my guess would be maybe one of the sign you enter wrong. How about the 621,000? That one should be a negative. So probably you entered positive. That's probably the reason. Oh, you didn't put a negative. That's probably the reason. So because you should get a negative if you enter the CF0 as a negative 221,000, you should get a negative $8,017.4553, 46 cents. Yeah. Okay. So I think you're pretty close, Cheryl. Yeah. Okay. So are you guys clear about today's exercise with me? Okay. So yeah, that's it. That's what I'm offering today with the 4 questions. This would definitely help you with your Connect assignments. Okay. So have a good evening, everyone. If you have question, please stay. Okay. Otherwise, the lecture is dismissed. Okay. Thank you, everyone.